Welcome to GAAP Governmental Accounting, a beginner's guide to governmental accounting. I am Olivia Crouch from Team Local Government Support here at the State Auditor's Office. This training is going to be a high-level overview of GAAP Governmental Accounting. We will start by discussing the different bases of accounting in governments. Since there is more than one basis, it is important to know which basis of accounting you are auditing so that you can apply the correct accounting criteria. Then, we will look at specific transactions and how to record them under the different bases of accounting. We will then dive into some example transactions and the differences between modified accrual accounting and full accrual accounting. This includes long-term debt and capital asset transactions, which are some of the major differences between these bases of accounting. We will also talk about inventories and prepaid items, which aren't usually significant amounts in governments, but there can be differences between the modified and full accrual, so we'll take a look at those differences. Finally, we will spend some time discussing revenue transactions, including the difference between exchange and non-exchange transactions, and how to account for various non-exchange transactions that are unique to governments, like property taxes, sales taxes, and grant revenues. We will end the training with a short discussion on expenditures and a summary of the differences between the modified and full accrual accounting. So let's get into it. Let's start with the basis of accounting. First up is defining the bases of accounting. There are several different ways accounting can be done. I'll briefly cover 3 of those. The first is normal accrual accounting. This is what is typically taught in accounting classes. You record revenue when it is earned and expenses when they are incurred, regardless of when the cash is exchanged. Then we have governmental accounting. In Washington State, there are 2 bases of accounting that local governments can choose from. One is cash basis, which is basically what it sounds like. Transactions are recorded when the cash is received or dispersed with some special rules. Next is GAAP, Generally Accepted Accounting Principles. This is accrual accounting with some additional special rules. This is what we're going to cover in our training today. Under governmental GAAP accounting, there are actually 2 bases of accounting. The first is full accrual, which is really similar to the normal accrual accounting. This is the accounting used in proprietary and fiduciary fund statements. It's also how the government-wide statements are prepared. If you need a refresher in basic accrual accounting, I recommend pausing this video and first watching the Accrual Accounting Fundamentals and Terms training. In governmental accounting, we also have what we call modified accrual accounting. This is what we use in the governmental funds. This accounting is very different from full accrual accounting. This training is going to focus on the special rules for modified accrual accounting and how it is different from full accrual accounting. The basis of accounting refers to when items are recognized, as in, do you recognize revenue when the cash is received or when the service is performed? There are different rules for when to recognize revenue between modified and full accrual that we'll look at later. Measurement focus refers to which items are recognized, as in, do you report capital assets or are they excluded? Economic resource measurement focus all resources that affect the economic position of the government. On the other hand, current financial resources only focuses on the financial resources that can be used to pay current obligations. Full accrual and economic resource measurement focus go hand in hand for our proprietary funds, fiduciary funds, and the government-wide financial statements. Most of this accounting lines up with what you think of as normal accrual accounting. The accrual basis determines when you record transactions. In full accrual, revenues are recognized when they are earned rather than when the cash is received. For example, if you perform work in December but don't get paid until January, that revenue was earned in December, so the revenue gets recorded in December. Similarly, under full accrual, expenses are recorded when incurred rather than when paid in cash. The measurement focus determines what gets recognized. Under economic resource measurement focus, we recognize all economic resources. For example, capital assets are economic resources because it can be used to provide services and further the government's mission. Similarly, long-term liabilities are recognized under this measurement focus. On the other hand, we have modified accrual in the current financial resource measurement focus. Under modified accrual, revenues are recognized when measurable and available. Notice how this is different from full accrual, which recognizes a revenue when earned. We'll go over what measurable and available mean later. Expenditures are typically recorded when incurred, except for those related to long-term liabilities. So unless the expense is related to long-term debt, pension, leases, compensated absences, or other long-term liabilities, it will be recognized at the same time it is under full accrual. Basically, if there's not a special rule for an expenditure, then record it when incurred. The current financial resource measurement focus looks at what resources can be used to pay current obligations. For example, cash can be used to pay bills, so it's a financial resource. On the other hand, capital assets are not considered a current financial resource because you can't pay your bills with a building. Long-term liabilities are also not recorded under this measurement focus because you don't have to use your current financial resources to pay them. You'll be using future rather than current resources to pay that long-term debt. I want to emphasize that for modified accrual, current financial resource measurement focus is not cash basis. There are still some accruals under this basis of accounting, as you'll see later in this video. Let's talk about the big differences first: capital assets and long-term debt. For each of these transactions, we'll cover the full accrual and modified accrual accounting so we can see the differences. A government purchases a building for $1 million, and it has an estimated useful life of 20 years. Under full accrual accounting, we record a capital asset. That asset is going to benefit us over many years, so we're going to spread the expense of this asset out over those years. We debit capital asset and credit cash for the $1 million. Under modified accrual, we do not report the capital asset because they are not current financial resources. However, we paid cash for this building. Cash is a current financial resource reported under modified accrual accounting. So we need to decrease cash through a credit. We know we can't debit capital asset because capital assets are not reported in modified accrual accounting. Instead, we're going to report an expenditure called capital outlay expenditure. Under full accrual, we depreciate the asset over its useful life. To calculate the depreciation expense, we divide the purchase price of $1 million by the useful life of 20 years. This gives us $50,000 depreciation expense each year. To record the depreciation, we debit the expense and credit accumulated depreciation. What about modified accrual accounting? Do we record depreciation expense? No, we have no entry to make here. We did not record a capital asset under the modified accrual, so we have nothing to depreciate. The entire $1 million was recorded as an expenditure already. The whole thing was expensed. Now let's talk about long-term liabilities. Governments have a lot of liabilities to report. However, long-term liabilities do not use up current financial resources, so they are not reported under modified accrual accounting. Some examples of long-term liabilities that are not reported under modified accrual include pension and OPEB, compensated absences, bonds and notes payable, asset retirement obligations, pollution remediation obligations, and leases and SPIDA liabilities. Instead, only the portion of the liability that is due and payable is reported. For example, let's say a government with a calendar year end has a $50 million bond. They have a $100,000 payment due on December 25th, but they don't make that payment until January 5th of the next year. They would report a liability on their financial statements for fiscal year end 12/31 of $100,000 in their modified accrual accounting. That's because the government needs $100,000 of their current financial resources, cash in this case, to make that payment. They are not reporting the full $50 million bond because they will use future financial resources to make the rest of those bond payments. So let's look at an example. So let's say the government issues that bond for $50 million. In full accrual, we do report long-term debt. We debit cash because we received cash, and we credit bonds payable, which is a long-term liability account. Modified accrual, however, does not report long-term debt. We do need to report that increase in cash though, so we still debit cash. It's the credit side of the journal entry that's different. This time we report what we call an other financing source. Other financing sources increase the total fund balance similar to revenue, but it's reported in its own section of the financial statements, separate from traditional revenues. Now a year has gone by, and we need to make a payment on this bond. Under full accrual, we recorded a liability. When we make a principal payment on the debt, it reduces that liability. To reduce the liability, we need a debit. We also pay interest on long-term debt, so we have interest expense to record as well, which is another debit. The credit to cash is the full amount of the payment, the principal plus interest. On the modified accrual side, we did not record a long-term liability, so we know we can't debit bonds payable like we did in full accrual. Instead, we debit debt service principal, which is a type of expenditure. We still pay interest, so we have a debit for that as well. This time it is called an expenditure instead of expense, but it's the same amount. The credit to cash is also for the same amount because the amount of cash paid out is the same under both bases of accounting. Now let's talk about some other assets, inventory and prepaid items. Under full accrual accounting, we record an asset when inventory is purchased. We debit inventory and credit cash. Then, when we use up the inventory, we record an expense, which is a debit, and reduce the inventory, which is a credit. Modified accrual actually gets a choice here. We have two methods, consumption and purchases method. Under the consumption method, the expenditure is recorded when the inventory is consumed. This is the same as the full accrual method we just talked about. Under the purchases method, the expenditure is recorded when the inventory is purchased. That means you debit expense and credit cash when the inventory is purchased. Governments are required to adopt a policy that chooses between these two methods, and you need to consistently apply the chosen method, meaning you shouldn't use purchases method one year, then switch to consumption next year. If you switch methods, you need to have a good reason for it and then use that method going forward. This choice also needs to be disclosed or explained in your notes to the financial statements. Prepaid items are treated similar to inventories. Under full accrual accounting, you record an asset when the expense is paid in advance. For example, a government's fiscal year end is 12/31, and they purchase an annual insurance policy on June 1st, which won't expire until June 30th the next year. They pay the entire insurance up front, so they prepaid it. They record an asset, which is a debit to prepaid item, and they credit cash. The goal here is to record the expense as it gets used up. As of 12/31, the government's fiscal year end, they have used 6 months of the insurance, which is half of the policy term. That means they will record an expense for half the cost of the insurance policy. They debit expense and credit prepaid item. Modified accrual gets a choice between the consumption and purchases method. Again, the consumption method is to record the expenditure as the prepaid item is consumed, which is the same as full accrual accounting. The purchases method is to record the full expenditure when the item is purchased. Government should pick a method, be consistent, and disclose this policy in their notes. Now let's talk about revenue and expense transactions. In governmental accounting, transactions are classified into exchange or non-exchange transactions. Let's look at the exchange transactions first. Exchange transactions are when one party gives something up and receives something of equal value. Think of when you go to the grocery store and buy food. You are giving up cash and receiving food in exchange. Most transactions that a private business engages in are exchange or exchange-like transactions. They are providing a good or service and charging their customers for it. There's a direct correlation between how much goods or services they provide and how much they charge the customer. Since they are in the business to make money, they don't normally give away services for free, and customers don't normally donate money to them without receiving something in exchange. Governments also engage in some exchange transactions. For example, a water district provides water to citizens and charges them based on how much water they use. There's a direct correlation between how much the citizen pays and the service they receive from the government. Exchange transactions are fairly easy because you record the revenue when earned and record the expense when incurred, which is basic accrual accounting. However, not all transactions that governments engage in are exchange transactions. Governments are unique. They're not in the business to make a profit. They're here to provide public services that can't or are not provided through private businesses. Think of potholes in the roads. Governments fix those without directly charging a specific citizen. They're providing a service without directly receiving something in exchange. So let's take a closer look at those non-exchange transactions. Let's think about how governments are funded. They do charge for some services, but usually the majority of their funding comes from taxes, grants, and other governments. Think about the property tax you pay. You give the government your money, and they use it to provide all sorts of public services, like parks, public spaces, schools, and playgrounds. The government is using our tax dollars to provide a benefit to the public, but there's not a direct correlation to what services you receive by paying your taxes. For example, the amount of property taxes you pay doesn't affect how fast the fire department will respond to your house fire. So we call these non-exchange transactions. Non-exchange transactions are further broken down into 4 categories of derived taxes, imposed non-exchange transactions, government-mandated non-exchange transactions, and voluntary non-exchange transactions. Starting with derived taxes, these are assessments that governments impose on exchange transactions. This includes income tax, retail and sales tax, excise and use tax, motor vehicle fuel tax, and more. For example, with sales tax, a customer purchases an item from a business. That's an exchange transaction. Then the sales tax is based on that transaction, meaning that when the exchange transaction happens, the government is now owed sales tax money. The sales tax is derived or based on that exchange transaction. Imposed non-exchange transactions are assessments imposed by governments that are not related to exchange transactions. This would be like property tax. Your house value is assessed, and you pay taxes based on that valuation. There's no underlying exchange transaction here. You are just taxed for owning a home. Fines and penalties are another example. If you get a speeding ticket, you have to pay a fine. There was no underlying exchange transaction, you just have to pay the government for breaking a rule. Next are government-mandated non-exchange transactions. This is when one government requires or mandates another government at a lower level to provide specific services. The higher level government also gives the lower level government resources to provide that service. One example of this type of transaction is the breakfast and lunch programs at schools. The federal government, the higher level government, requires school districts, the lower level government, to provide food to students. The federal government also gives the school districts grant funding to help the school district pay for the food program so they can offer lunch and breakfast at no or low cost to students. We don't see a lot of these transactions at the local government level. Voluntary non-exchange transactions are much more common. This is where both parties willingly enter into the agreement. An example of this is when a local or state government applies for federal grants or awards. The federal government is not requiring them to participate in that federal program, but the local or state government wants to participate to get federal funding to help provide services in their area. Remember, we are talking about non-exchange transactions here though. In this example, the federal government gives money to the local government, but the federal government doesn't receive anything in exchange. On the other hand, if the local government provided a service to the federal government and the federal government paid them for that service, that would just be an exchange transaction. Just because two governments are entering into a transaction together does not automatically mean it's non-exchange. You really have to think about what each party is giving up and receiving to determine whether it's exchange or non-exchange. Now that we talked about the different types of transactions, let's review the revenue recognition criteria. For full accrual accounting, revenue is recorded when earned. It's easy to tell when revenue is earned in exchange transactions because it means the government has fulfilled their duties in the transaction, i.e., they provided the service or supplies. It's a little harder, though, in non-exchange transactions where there's not that direct correlation between what is received and what is given up. We have specific criteria for when to recognize non-exchange revenues that we'll talk about as we look at specific examples. Modified accrual, however, has additional rules. Revenue in modified accrual accounting is recognized when it is measurable and available. Measurable means the government knows how much it is, or they can reasonably estimate the amount. Available means it's collectible within the current period or soon enough after the current period to be used to pay liabilities of that current period. Collectible within the current period means it was actually receipted during the fiscal year. Collectible soon enough thereafter means that it was collected shortly after the fiscal year end. This time frame is actually set by the government's policy. Some governments have a policy that say only amounts collected within 30 days of fiscal year end are available, and other governments have policies that say amounts collected within 60 days of fiscal year end are available. We'll practice this concept and some of the examples in a few minutes. Before we move on to examples, let's discuss receivables. Receivables are often the other side of the revenue transaction. In both modified and full accrual accounting, the receivable is recorded when the government is owed money or other resources. There is no difference in when receivables are recorded between the two bases of accounting. The difference is in the revenue recognition or when the revenue is recorded. Let's practice. Let's start with sales tax, which is a derived tax revenue. For derived tax revenues, the government has the right to the revenue when the underlying exchange transaction takes place. For sales tax, that's when the underlying item is sold. In both modified and full accrual, the sales tax receivable is recorded when that underlying sale takes place. Remember, the receivables are the same. It's only the revenue recognition that's different under the two bases of accounting. For full accrual, derived tax revenue is recorded at the same time as the receivable. However, under modified accrual, the revenue can only be recognized when it is measurable and available. Most of the time, sales tax revenue will be measurable because local governments get reports from the state that say how much sales tax they are owed. Or the local government can estimate how much they will receive if the exact amount is unknown. So we'll need to know if the revenue is available. Let's assume the following facts. A store has sales in December. The store prepares the report that calculates how much sales tax they owe in December. All of the sales tax is remitted directly to the state in January. But some of the sales tax sent to the state actually belongs to the local city. The state just collects sales tax for all governments to make it easier for stores remitting their sales tax. The state collects sales tax revenues from all businesses and then remits the amount owed to the city in February. In this example, the city's fiscal year end is 12/31. What gets recorded in December? For full accrual accounting, the receivable is recorded and the revenue is recognized. That means we debit sales tax receivable and credit sales tax revenue. For modified accrual accounting, the receivable is also recorded. Remember, the receivable amounts will be the exact same. What's different is the revenue recognition. The debit side of the transaction is the same, sales tax receivable. It's the credit side that depends on whether revenue is available. So let's determine whether this revenue is available or not. Here's our timeline. In December, the sales occur, at which point the city is owed sales tax revenue. That's why they record the receivable in December. Sales tax gets remitted to the state in January, and the state remits the city's portion to them in February. Now let's assume a 30-day availability period. 30 days after fiscal year end is January 30th. So everything receipted after January 30th is not available. Since it's receipted by the city in February, which is after January 30th, it's not available. That means it cannot be revenue under modified accrual accounting. So as of December 31st, the city has a receivable, but no revenue under modified accrual accounting. Instead, they record a deferred inflow for unavailable revenue. Now in February, when the cash is receipted, full accrual debits cash and credits sales tax receivable to reduce it. Remember, in modified accrual, we also recorded a receivable. So we need to remove that receivable now that we have the cash. That entry is the exact same as full accrual. What's different is that deferred inflow we recorded in modified accrual. We need to get rid of that now that we have received the cash. Since we originally recorded a credit for deferred inflow, to reverse it, we need a debit. The credit side of this transaction will be sales tax revenue. Notice how in full accrual, the sales tax revenue was recorded in December. But under modified accrual, with a 30-day availability period, the sales tax revenue wasn't recognized until the next fiscal year. Now let's assume the city has a 60-day availability period. How does that impact our journal entries? The initial timeline is still the same. Sale happens in December, money is remitted to the state in January, and then remitted to the city in February. The only thing that changed is the city's policy for how long their availability period is. 60 days after fiscal year end is February 29th or March 1st, depending on if it's a leap year. So that means the sales tax receipted in February is available if their availability period is 60 days. Since it is available, it meets the criteria for being recorded as revenue in December. That's the same journal entry we recorded under full accrual accounting. We debit the receivable and we credit the revenue to recognize revenue in December. Notice that the year revenue was recorded in under modified accrual accounting depended on the city's availability period. When their availability period was only 30 days, the sales tax revenue was recorded in the next fiscal year in 2025. But when their availability was 60 days, the revenue was recorded in the current fiscal year in 2024. Each government should set their availability period in policy. The availability period needs to be applied consistently from year to year. That means you pick one time frame and you use the same one each year. Now we'll move on to imposed non-exchange transactions. And we'll look at property tax, which is a type of imposed non-exchange transaction. Government should recognize a receivable from imposed non-exchange transactions when they have an enforceable legal claim to the resources. For property taxes, the legal claim arises when the taxes are levied, which is January 1st in Washington. That means on January 1st, governments that levy property taxes have a receivable. In rare circumstances, governments will receive the cash before they have a legally enforceable claim. For property taxes, that would be prepaying the 2026 property taxes in 2025, which is before those 2026 taxes were levied. In this case, a government wouldn't report a receivable because they don't have that legally enforceable claim yet, but they do report the cash. So let's look at an example for property taxes. Let's say the government levied $5 million in property taxes. Throughout the year, they collect $4.5 million. In January the next year, they receive $250,000, and in February, $150,000, and the remaining amount in March through December of the next year. For full accrual, all of the revenue is reported when taxes are levied. That means all $5 million is revenue in full accrual. Modified accrual, though, needs to consider when the property taxes are available. Let's assume a 60-day availability period. That means the revenue collected in January and February are available. So we add the $4.5 million collected in 2024, we add the $250,000 collected in January, and we add the $150,000 collected in February to get a total of $4.9 million of revenue that's recognized under modified accrual. The remaining $100,000 that's collected after the availability period is unavailable, and it will not be revenue in 2024. Instead, it's recognized as revenue in 2025. Let's take a quick look at the journal entries for property tax. On January 1st, under both full accrual and modified accrual, the receivable and revenue for the full amount of the levy are recorded. As the taxes are collected throughout the fiscal year, we increase cash and decrease the tax receivable. But remember, under modified accrual, only $4.9 million can be recognized as revenue. And as of right now, with these journal entries, we've recorded the full $5 million. That means we need an adjusting entry to correct this. The adjusting entry is to reduce revenue. To reduce revenue, we debit. Since the $100,000 is unavailable, the credit side of our transaction is to deferred inflow, unavailable revenue. This reduces the property tax revenue reported in modified accrual to $4.9 million. Then in January, the next fiscal year, this adjusting journal entry is reversed. This process effectively moves the $100,000 of revenue from 2024 to 2025. Let's move on to the last two non-exchange transaction types. Government-mandated and voluntary non-exchange transactions are accounted for the same way. The most common example we see is for grants or awards. To recognize revenue, all of the eligibility requirements must be met. That means the government has the required characteristics of an award recipient. If a government has gotten an award or applied for and was approved for the award, they typically meet these requirements. If they didn't, the award probably would have been denied. There are also time requirements. Time requirements refer to when the recipient is allowed to use the award or grant. A government cannot recognize revenue if the period when they're allowed to use the grant money has not started. Reimbursements refer to when a government has a reimbursement basis grant. That's where they incur eligible expenditures and then get reimbursed by the grantor. Governments must have incurred eligible expenditures to recognize the related revenue. The contingency requirement applies only to the voluntary non-exchange transactions. This just means that if the grantor's award is contingent upon some action, the recipient has to perform that action before they can recognize revenue. In full accrual accounting, the government recognizes the receivable and the revenue when all eligibility requirements are met. This includes incurring those eligible expenditures. Remember, in modified accrual accounting, the revenue also needs to be available. Let's say we have a reimbursement basis grant. The government spends $8,000 of their own money on grant activities that will eventually be reimbursed by the grantor. At this point in the process, we're assuming they have the required characteristics of a recipient. Otherwise, they wouldn't have been awarded the grant. We assume they meet the time requirements, meaning when they spend this money, it's within the time frame specified by the grantor, and they know the grantor will reimburse them. We don't have information on contingencies in this example, so we'll assume that there are none. The last eligibility requirement they need to meet is incurring eligible expenditures. This means at the time they incur those eligible expenditures, they have met all the eligibility requirements. That means they are recording the grant revenue at the same time they record the expenditure. The expenditure journal entry is a normal expense, debit expense, and credit cash or accounts payable if not paid in cash. At the same time, they are recording the grant receivable. Now that they have eligible expenditures, the grantor owes them reimbursement, so they debit accounts receivable. The credit side is grant revenue in full accrual accounting. Normally, it will be grant revenue and modified accrual accounting too. But we also have to make sure the revenue is available. Was it received in the fiscal year or within the availability period after fiscal year end? If so, then it's revenue. If not, if it's received after that availability period, the government will need to record a deferred inflow for unavailable revenue instead. Sometimes governments receive grant or award monies up front before they spend their own cash. In this case, they have not met all the eligibility requirements because they have not incurred those eligible expenditures. This means they have an unearned revenue. Both full accrual and modified accrual will have a debit to cash and a credit to unearned revenue. Unearned revenue is the same between modified and full accrual. The revenue is recognized as the government has eligible expenditures. Again, when they incur those expenditures, they debit expense and credit cash or accounts payable. They also recognize revenue by crediting grant revenue. This time, though, they don't have a receivable because they already receipted the cash. Instead, unearned revenue is reduced through a debit. This time in modified accrual, we don't have to worry about whether to report revenue or deferred inflow. The government has already receipted the cash before the grant started, so the revenue is available. They already have that cash. All of this information about non-exchange transactions can also be found in GASB codification. GASB runs the Governmental Accounting Research System, or GARS, which includes all of the GASB standards. Once you navigate to their website and log in, you will see the codification menu on the left. Non-exchange transaction guidance is in section N50. I encourage you to navigate there and spend a few minutes getting familiar with GASB's codification layout and reviewing the non-exchange transaction information. We're going to finish out with a quick discussion on expenses and expenditures. Under full accrual, we use the term expense, and we report those expenses when they're incurred, regardless of when the payment is made. Modified accrual, on the other hand, uses the term expenditure. These are also recorded when incurred, except if they are related to a long-term liability. Remember, we don't report long-term liabilities in modified accrual, so we don't accrue the expenses related to them either. Instead, the expenditures are recorded when due and payable. If there's no specific GASB guidance for an expenditure, then generally it should be accrued. There's also no availability period for expenditures like there is for revenue. So for example, if the government receives a phone bill for services received in December, but they don't pay that bill until March of the next year, they still need to report that expenditure in December of that prior year because that's when it was incurred. The revenue availability period is irrelevant to expenditure accruals. So here's a summary of the differences that we covered between full accrual and modified accrual. Under full accrual, we use the economic resources measurement focus. It applies to fiduciary funds, proprietary funds, and government-wide financial statements. On the other hand, modified accrual uses the current financial resources measurement focus, and this applies only to governmental fund financial statements. Capital assets are reported in full accrual, but not modified accrual. However, long-term receivables are reported under both bases of accounting. Prepaids and inventories must use the consumption method under full accrual, but they can choose between consumption or purchases method under the modified accrual. Both bases of accounting report accounts payable, which is a current liability. However, only full accrual reports those long-term liabilities. Revenue is recognized when earned under full accrual, but under modified accrual, the revenue must also be measurable and available to be recognized. Expenses are reported under full accrual when incurred. Modified accrual also recognizes expenditures when incurred unless they're related to those long-term liabilities. Hopefully you feel more familiar with modified and full accrual accounting in governments. If you have questions, I encourage you to submit a help desk. Thank you.